Welcome.
It's not a bad day today, and it feels nice how we're sort of coming towards at least a bit of spring.
Yeah, definitely. Hi Dan, welcome.
Hi there. How many people are you expecting, Anton? What?
He's on mute. I'm not sure.
Okay. Oh, he's on mute.
All good hosts join the latest there, I hear. Unfortunately, it took me a while. I'm sorry. Dan and everyone else, can I kindly ask you to turn your cameras off, please? And we'll keep this a audio only for everybody. Perfect. Well, thank you very much to all of you for joining us today. Well, guess what? This is our 130th Startup Fundraising Q&A. We've been doing these for almost 4 years now, where over 270,000 people have tuned in to, I guess, participate in us helping about 2,000 founders so far. And none of that would have been possible without the amazing people, all our fellow panelists that we have today with us on the panel. The idea is quite simple. You see, unfortunately, over 90% of businesses, startups that is, fail. And the top 3 reasons for that are 1, market fit, 2, running out of money, and 3, not having the right people. And there couldn't be anything more important about your ability to, well, not only survive actually, but to thrive as well, if you want to, in your business, then your ability to raise money if you run out of it. We don't all have rich aunties and uncles to leave us money. Neither do we have, do we all have friends that we can just call up and ask for a check? Most of us need to raise. Now, some of you that have joined us before know that I'm not the biggest fan in the world of raising, but we all, or most of us, need to do it one way or another. And that is why today I've got with us 5 brilliant experts who've been there and done it. We should actually be joined by another one soon, hopefully. But nevertheless, you see, the idea as to how it works today is we will go through some quick introductions, then open it for questions from the audience. And then after that, we will, well, take your questions and see if we can answer them as best we can, really. In terms of what we're going to do, because there's a few of us, it might be a good idea if we take no longer than a minute each on the panel to both introduce ourselves, but also answer questions. Right after the introduction, by the way, if we can all take, well, I wouldn't do that, but my panelists might be a good idea if you can. Think of one do and one don't in terms of early stage fundraising that is important to you, that you've seen happen often. Also, if you can, please keep your mic off unless you're talking, because it creates an echo and it's not that great. Now, I see quite a few people that have joined our live stream. So if you're tuning in via LinkedIn, YouTube, Facebook, or Instagram, please be aware that unfortunately we're unable to monitor your questions there. So you would need to join us here interactively on Microsoft Teams. By the way, it's audio only, so you don't need to spend much time in front of the mirror doing your hair before you join us. That means you can join us from any device and anywhere, or any platform for that matter, wherever you are on Microsoft Teams. Now, if for any reason you can't get through to our Microsoft call via that link that I've shared on your live stream, then just go to our website, StartUP You click and find today's session, which is Startup Fundraising Q&A 130, and then click join. It's a quick registration. You'll then get an email to your, a link to your email for you then to be able to join us. We're going to be here for the next 55 minutes. So 55 minutes do go much quicker than you'd think. Therefore, if you want to ask us questions, make sure you're here on Microsoft Teams. Once you're in, all you have to do is type your question in the chat here, and then I'll give you the mic so that you can ask our panelists. But if your questions today are not on fundraising, please save them for the other events we run. Mondays, it's talent. Tuesdays, product and tech. Wednesdays, growth. Obviously, Thursdays, as you can see today, it's fundraising. Second Friday of the month, it's legal. And third Friday of the month, it's finances. They're all from 12 to 1 p.m. UK time. And obviously, they're all free and equipped with some wonderful panelists like the ones today. And also, you can RSVP via our website to any of them, StartUP to ScaleUp.com. And actually, if you're there, you might want to join our WhatsApp group. At the top and bottom of that site, you'll see a WhatsApp icon. And if you join us there, you'll be able to get alerts to all future sessions. Now, without further ado, some quick introductions. My name's Anton Cole. I'm an Albanian in London working with startups normally right after they get investment. I embed within their teams and help them hire and keep the right people. I also do some growth advisory work with a few other startups and accelerators. And I've also been helping a few angels and family offices with their due diligence and assessments. And in terms of the order of things, we will start with Alessandro, then Alexander, then Archie, and then Dan, please. Take it away, fellas.
All right, thanks so much, Anton. Excellent to be here. Thank you for your time, everyone. So very quickly, Alessandro Mele, Italian in England. My background is in investment banking, and I've been an entrepreneur since 2008. And then I've also become an investor myself. And my main activity is as co-founder and CEO of Ethical Fin, which is an FCA-regulated, London-based financial advisory company, very much focused on the impact space. So we support founders which have developed solutions to significant social and environmental issues through commercially viable solutions. And so that's that's what I do. Anton, you want me to give already the do's and don'ts now, or should
No,
should
don't worry. We'll go on to the others for the introductions, but think of a quick do and don't, all of you, if you can, please. But let's do the intros first.
All right.
And I
Okay,
believe
I'll
the next
stop
one
there then.
is, thank you, buddy. The next one is Alexander. Alexander Fink, please.
Thank you. Hi, Anton. Thank you very much for having us on here. We're a single family office originally. We deployed capital using up our EIS, SEIS allowances. We've looked at, as a family office, a number of verticals, fintech, climate, prop tech. We then really wanted to get into life sciences and deep tech, but as a family office, we had no way of diligencing it. That's why we started up Empirical Ventures. I partnered with one of my friends from university to start up Empirical, which was originally Science Angel Syndicate. We look at deep science companies. We are EIS, SEIS, KEIS fund. We look to deploy into companies with a deep scientific moat spanning 4 different areas. Life sciences and medical, which are both therapeutics and medical devices. Deep tech, which can be anything from space to clean energy, advanced materials, and robotics and automation. And we really solved the problem as a fund with the thesis of a lot of other funds or startups were coming to us going, I've got a fund interested, but we need a lead science investor that can diligence the science on our startup. And we've really taken on that role because until we came along, there was no magical lead science investor. And so we've plugged the gap there for early stage companies.
Thank you very much, Alexander. I believe we've got Archie now, and then Dan, please.
Thank you very much, Anton. Archie Thomason from Fresco Group. We have 3 strategies, and that's in our farmland side. We're just at the moment acquiring our first asset there in Australia. It is degraded farmland in Queensland, Australia, which we look to convert into more regenerative practices, and in particular the use of cattle involved in that. The other side is our private equity initiative in the agri-food system, in particular in Europe and the UK. We found that there were, with a lot of us having VC backgrounds, we found there were a lot of companies which were maybe a bit later stage, the higher revenues, but didn't quite fit into that VC bucket. We look to acquire them outright with SPVs and do a buy and build strategy. But where there's more overlap probably for this webinar is in our corporate finance and advisory aspects of the business. With my background being originally in VC, at a small asset manager in London, I'm well connected in the investment networks and with startups, and as a result, we've leveraged that through support for biotech and agri-food companies, helping them raise go-to-market strategies, etc. really. And it's a pleasure to be on this webinar, and hopefully it can be of some help.
Thank you very much, Archie. Last but not least, Dan, the floor's yours.
Hi, good day, everyone, and pleasure to be with everyone on this Steam panel. My background as a positive history is as an entrepreneur. I was an entrepreneur who had about 4 startups. I've raised for 3 of them. I've exited 2 of them, and I've learned a lot of lessons from one that failed miserably, I suppose, as well as being an occasional angel investor. I'm an advisor on a venture capital fund, and I guess what I'm known for is being chief executive of Ideas Crucible, Ideas Crucible raises capital for a lot of intellectual property rich startups from sort of seed to Series B, a lot of science and engineering startups, but we also do a fair bit of fintech, particularly when there's some interesting, clever technologies such as AI or cybersecurity involved. We do quite a lot of university spin-outs, not just in the UK, but also doing one in Brazil, one in Stanford University at the moment, one in Cambridge, where we help a lot of academic spin-outs and universities see eye to eye and manage that kind of license and IP process and capital raise. We work with about 800 investors, private equity, family offices, but 200, I say, actively, many of which we've got mandates for investment.
Well, that's brilliant. Thank you very much to all four of you. Well, you've heard them, people. We've got some amazing panelists with us today, and they're willing to take any questions we may have on fundraising. We've only got 47 minutes with them, though. So for those of you that I can see on the live streams, whether that's LinkedIn, YouTube, Facebook, or Instagram, please be aware that there's no point in sending me messages or comments or emailing or whatever you may be doing right now, because I can see my phone signaling basically. Unfortunately, we're unable to monitor your questions there. So if you do want to join us interactively, you need to click on that Microsoft Teams link that you should have on all of the live streams. But if for any reason you can't access that, then all you have to do is go to our website, startup-to-scaleup.club, find today's session, which is Startup Fundraising Q&A 130, and then click on join. Once you click join, you'll be able to get an email with the joining link, basically, and that way you can be here with us. Once on Microsoft Teams, then all you have to do is type your question in the chat room, and then I'll give you the mic to open, well, to ask the panelists. And by the way, there are no wrong questions, and there's no need to be shy. It's a learning curve for us all. In terms of fundraising questions, they can be on anything from, I don't know, let's say investor outreach, pitch decks, data rooms, valuations, equity, due diligence, grants, angels, VC, CVC, crowdfunding, exits, and all that jazz. There literally is no sort of wrong question. But by the way, if you've got questions on other matters, please then save them for the other rooms and conversations we host. Monday's talent, Tuesday's product and tech, Wednesday's growth, and Thursday's fundraising. They're all from 12 to 1 p.m. UK time. And we also have two monthly ones, which is second Friday of the month. It's one on legal, and third Friday of the month, there's one on finances. Again, they're from 12 to 1 p.m. UK time, and you can RSVP to them via our websites as well, which is StartUP.club. And actually, when you're there, you might want to join our WhatsApp group. You can see an icon of the WhatsApp group at the top and bottom of your page. So click there and you'll get alerts to all future conversations. Now, let's keep it to under a minute, please. One do and one don't when it comes to early stage fundraising. We'll start again in, I think, the same order we went last time. So Alessandro, Alexander, Archie, and then Dan, please. Your 1 minute of glory starts now.
All right. I didn't have my countdown. So definitely a do is, in my opinion, do your research and homework. I see a lot of presentations and a lot of founders who don't really prepare very well investor meetings, and that means preparing a well thought through deck, doing your research around your market, your competition, and making sure that your data room is up to scratch, and then do your research also around the investors you're meeting so that you're well prepared. In terms of don'ts, the biggest for me is don't second guess investors' conversations, but stay very much focus on level playing field with investors and ask lots of questions, as opposed to second guessing in your mind what they're thinking and trying to address those those concerns yourself directly. Stop there.
Thank you.
Good man, thank you very much. Yes, Alan.
Yeah, so I've got a number of do's and don'ts from doing this. So on fundraising, I would say do take more money than you need if you have the chance to overfund. Do make large contact lists of VCs. It's a numbers game, so make sure you're speaking to as many people as possible. And even if it's not a right fit, keep the dialogue going, keep updating the VCs on progress made from the start of your fundraise to the end. And do ask them, do you think there's another VC that that's in your network that this may be of interest to? And then when you come to investing, I would say do the research on the funds that are coming into your company, especially if you're giving away board seats. On the don't side, I would say the key one that I see repeatedly when startups get successfully funding is don't overhire. Don't make sure that everyone that you do hire is 100% bought into the company, and really don't waste the money that you've got. Try and lengthen the runway, because fundraising always takes more time than you think, and work and progress on your startup is never as quick as you think it is as well. So those are my pieces of advice.
Thank you very much for that. Archie, what is your do and don'ts?
For my do, I'd sort of just reiterate what Alexander said. It's incredibly important to stay in contact with these investors who, you know, may be on your first conversation said it's out of their wheelhouse. It's not even within their sector interest, or perhaps the stage just isn't quite right. To give you just a little example of something there, a fundraiser for a company at the moment who, during their seed round, a VC said no for X, Y, Z reasons. 2 years down the line, we're going back to them again, and in due diligence. That is not simply a coincidence of 2 years of silence. That's 2 years of keeping them up to date on milestones, achievements, and learning from the criticism they initially gave. And yeah, so then on the don'ts, I would say part and parcel again. It's about the relationship and about them knowing you, and as a result, I would say don't hide the challenges that you have faced during this development process, and also challenges for you as a person of building the company. Recently, again, another example, I spoke to a founder. He's creating a search fund, and you know, he told me he'd left his job at a renowned place and he's renting out his flat, and he is, you know, sofa surfing whilst he builds this company. Just this helps the investor, the angel, the family office, for example, understand you as a person who, you know, are going to be driving forward this company that they're going to be investing into. Yeah, those are my do's and don'ts.
Thank you very much. And last but not least, Dan, and also the others, I'll put a question in the chat. I'll read it out loud after Dan's wisdom, but maybe you want to read it up. Dan, what's your do and don't when it comes to early stage raising?
So for early stage, and for that matter, even for mid and late stage, keep your proposition focused and articulated. Even more so relevant with later stage in some ways. There's a habit with early stage startups to kind of throw everything that they'll be doing in the plan and the roadmap at day one, when it's really about the core proposition and what's going to generate that, you know, generate the early money. So really think succinct, you know, this pill, take this, solves your headache, that kind of thing. You know, look at the kind of classic propositions that have been out there that are really clean: rent your home, Airbnb. So don't overcomplicate it. Yes, there's probably lots of things you can do on the back of it, just like Amazon was just a bookshop originally to being many other products, but keep it clear in the early stage, particularly. In terms of, it's a people relationship, so take this as a do or a don't, really. Remember, this investor is just another person in the end of the day, trying to find someone that they can work with, that's likable, coachable, will take their feedback, but equally so, will push back with some good know-how, and they've got some, when they can input it. So it's a working relationship, and don't take that kind of feedback I'd say don't take it personally or negative. Take it as something that you can learn and improve on. And it comes back to some of the previous points from the panels. Usually that investor says no is often the first person that's going to, if they want you to succeed, who point you in the right direction are those that are investors that can help you. And I guess one point to mention is that we see a lot of startups fail. It's some great products, but they've really got a poor product market fit. So make sure that product is really addressing that market as opposed to maybe another market at the end of the day.
Thank you very much for that, gentlemen. Really appreciate it. Right, Joe. We've got a question that was sent in, so I'll put that in the chat. But for the others, as you watch or hear the streams that we've got on either LinkedIn, YouTube, Facebook, or Instagram, please be aware that unfortunately we're unable to take your questions and monitor your questions there. So if you do want to ask us anything and you want to ask our panelists, you'll need to join us here on Microsoft Teams. It's audio only, and you can do that by either clicking on the links that I've shared on all of those live streams, or simply come into our site, startup-to-scaleup.club, find today's session, Startup Fundraising Q&A 130, click join, and then it's a quick registration, and you'll be able to then hop into our call. By the way, you'll then receive a link to do that, so bear that in mind. When you get to Microsoft Teams, then just type the question in the chat, and I'll give you the floor. So I'll unmute you, give you the mic basically, and you can ask our panelists. But for now, what we'll do is we'll go to a question that was sent in. Okay, so this is from an AI tech founder, isn't everybody these days? They're based in Cambridge, seed stage, and she is a data scientist by background. And then she says, we're reaching out to corporate VCs in the tech sector for funding. What are the key red flags to watch out for in term sheets from corporate VCs that could indicate potential conflicts of interest? And how do I negotiate terms that protect our independence? So we've got two matters here to quickly discuss. Number one, in terms of conflicts of interest, whether they're trying to do this so that they can maybe give things to another company they have in their portfolio, or maybe do it themselves. And of course, in terms of independence, it could be anything from them pretty much deciding on everything, or two, them actually doing it to acqui-hire them or take them out of business in order to have that share of the market. So for this, what we'll do, again, please keep it to 1 minute. Let's start with Dan, Archie, Alexander, and then Alessandro. Your minute of glory starts now, Dan.
So there's different kinds of corporate VC. So first of all, make sure you understand the kind of corporate VC you're talking about and their rationale. Is it a traditional VC? Is it a VC arm that's sitting on the side of, for instance, a bank or an organization that has independence? So, or is it, is it just used to kind of drive innovation within the larger corporate structure, and it's got a strategic focus of whatever the core business is, banking, telecoms, whatever? A good starting point, if you're speaking with CVCs, is to maybe speak to some of the people that have already invested in them to find out what the kind of pitfalls were and the challenges were, so you can be prepared. Coming back to the previous panel, preparation is everything at the end of the day. In terms of conflict, like if you were to sell to, I don't know, your music startup to startup, are you worried there's going to be a conflict with that, or you're not going to be able to license it out to Warner Brothers or something like that? That's something you might be aware of, but that should be covered by the general terms in the term sheets. Don't kind of, don't be too concerned. You can get caught out with poor term sheets, whether it be a CVC, a VC, or an angel. The one things that you tend to have to worry about with corporate venture capital is make it very clear whether there's good follow-on funding. A lot of them are not very good on follow-on funding, and if that's important to you, and sometimes it should be, because if you don't have to keep firing the pistol every time you do a fundraise, it can be making life a lot easier, because your job should be running your business, not raising funds at the end of the day. And you really want to understand what the North Star goals is, that CVC. Do they shift? Are they quite clear? Are they crisp? Have a look at some of the companies that are exited there. and the kind of portfolio to see if it really is a good blend, and you're going to be a good fit. I'd say one of the first things generally with all investors, I should say, is don't feel you have to take the money just because they present it, by the way. Getting rid of an investor is harder than getting rid of a wife or a husband. Make sure they really work for you, and don't be afraid to say no, because the pain trying to do that, even though you needed money, is really, really hard. And I spend a lot of time legally, having to handle investors that are tough.
Thank you very much for that, Dan. I believe next one's Archie, then Alexander, then Alessandro. Let's all keep it to 1 minute, please, i.e. 1 minute each.
Thank you, Anton. Completely agree with what Dan was saying there, in particular about getting to know them in order to actually know what their motives are, and speaking to the previous investee companies. From my side, I see this sort of concern in particular in the ag chem industry. CVCs there looking to invest in startups, and one of the things with the startup is trying to understand how independent is the CVC, although it may be an arm of, for example, FMC, Corteva, etc. How involved are they, and are they, perhaps just investing from a pool of money, or are they speaking to the scientists on a daily basis? So from my side, in particular, in the term sheet, look at first rights of refusal. You may be interested in how much influence that corporate VC has on the board. Are they a board observer? And what would their voting rights be? And then, importantly, again, looking at my own experience, ag chem companies, potential exits. You need to negotiate a non-exclusive M&A terms, really, to keep it open for yourself and keep it attractive to other investors coming in. Ideally, bring in 2 corporates is always an interesting scenario, but
thank you very much, Archie. Alexander?
I agree with both what Archie and Dan said during their minute. CVCs can be, the greatest blessing or the greatest curse of coming into a startup. We see a lot in the biotech space. You get a lot of the big pharma companies wanting to invest in early stage therapeutics that we look at. And having them on the cap table is a great positive influence, because they could be your potential acquirer. The key to it, I would say, when you've got a CVC, is make sure they're part of a round and not the whole round. Otherwise, their motives could be bleed you dry and then acquire you for cheap. But if they're part of a large round, then it keeps them in check when negotiating term sheets. Just make sure there's a lot in there about freedom to license what you're doing to other people, including competitors, that they can't restrict you in any way from making sales. But ideally, if they're coming in, they are going to be a customer as well and will want you to do well. So sometimes having them on the board's a good thing, because they've got to act independently and in the best interest of the company, not just in the best interest of the CVC.
Thank you very much, Alexander. Alessandro, what are your thoughts on this?
Yeah, amazing insights from everyone before. So a couple of considerations. I think at the end of the day, conflicts of interest are everywhere. And so in addition to what everyone else has said, a couple of tips that come to mind is, one, make sure that you build a really strong trust and transparent relationship with the corporate VC investors. The challenge there is that these are typically large organizations, so normally you would have one point person within the organization leading the discussions and the negotiations. So one tip I would give is to really ensure that you have exposure to as many people and as many decision makers as possible in the corporate, so that you are, let's say, hedging the risk of, key man risk of your relationship person leaving, and therefore, leaving you without any relationship, in the corporate VC. And the other key element is how to manage the relationship between the commercial risks and investment risks. So as an investor, the company will be aligned, but as a commercial counterparty, as a client or promoter of your product, they will have the interest of paying, for instance, paying as little as possible for the product or the service you're offering. And so having a very clear and transparent arrangement around that can be extremely useful.
Well, thank you very much to all four of you. Really appreciate that. We've got 27 minutes to go, so if you've got any questions, please, you need to come here onto our Microsoft Teams call and type them in the chat, and then I'll give you the mic to ask the panelists here. Nevertheless, we have some other questions that were sent in. Yeah, this is a good one. So this is a PropTech founder in Birmingham. They're pre-seeds and an ex-property developer. He goes on to say, my platform automates property valuations for real estate agencies. Investors are concerned about the relatively low transaction frequency in property sales. Oof. How do I demonstrate a strong revenue model that overcomes this challenge? And what metrics should I use to provide that we can scale, to prove that we can scale beyond initial users? Perhaps for this, we can start with Archie, then Alexander, then Alessandro, and then Dan. And let's try and keep it to a minute so that we can go through a couple of other questions after, please. Archie, your minute of glory starts now.
Thank you, Anton. I'm afraid I think in this specific area I won't be of much help, but I'll see if I can offer a few nuggets. So it sounds like you're early stage. You've got a bit of revenue in particular but this may be a little lumpy, and from majority from one or two people or companies. How to look at this or to present this differently? I don't know. Look at the recurring revenue metrics you can maybe go into. Is the revenue you've had so far, can it be recurring or repeatable? Perhaps look at the amount of user engagement to adoption rates, compared to the amount of people you've actually gone out to and tried to sell to, or material has gone to. What does the adoption rate be there? Emphasize to your investors that you are a pre-seed company, you're early stage, and you are someone who has worked in the industry, it seems, and has gone to another side now of the sector, and as a result you understand that there is a SOM out there. There is a serviceable, attainable market for you to convert into revenues, and naturally that takes time. But I'll pass on to anyone else who has.
Thank you very much.
More...
Just to clarify this, because it's a valuations PropTech, unless he's going to come up with some other extra sort of sideline products, there isn't much you can actually do, unfortunately, to come up with recurring. Because once a property is valuated, the likelihood of that needing to be sold soon after is quite slim. But I hear what you're saying. And by the way, for the others, if you feel it's not your field, don't worry. It's fine to say pass. Let's now go on to Alexander, then Alessandro, then Dan, please.
Thank you. Interesting question. I would say on property valuations, with a bit of PropTech experience, I'd say it's used more than just for the sales. People like to know the value of their property prices going up or down, and what the mark to market is. Rightmove, some of the others have done well off this. There's more to the game than I would just say real estate agencies. You kind of got to think about how you broaden out the market, either from a different product or through different types of people you can sell into. But valuations go on all the time, and in the UK, people are obsessed with the price of their property. So I think as well, revenues and models, again, your early stage, it's a metric. No one quite knows exactly how it's going to play out or what market you can end up in. So as long as you can kind of justify it, everyone knows the forecasts are going to be over optimistic. So rather than be conservative, I would say try and be optimistic with your figures and think how many times will it happen.
Thank you very much for that, Alexander. Alessandro.
Yeah, so I think showing the value added of the solution versus the real cost for the agency might be a valuable way to show investors the value added, the cost saving. So doing a sort of return on investment type of analysis, so that even though you don't have a lot of sales, you can demonstrate the value of the property valuation tool. Secondly, the other idea that was coming to my mind was targeting large real estate owners who hold a significant amount of assets in their portfolios and need to report frequently their mark-to-market and asset under management valuations for regulatory reasons. So you then, you would then help automate the real estate valuation process for those. Thirdly, surely understanding what type of social media and marketing campaigns can yield the best results in terms of increasing the pipeline. And so, the KPIs that you can look at are new inquiries, new conversions, speed, between the campaign and the number of inquiries that come for the valuation. So you can actually build up a funnel for your pipeline of potential clients and show very clearly how that is evolving over time. And hopefully that will give some confidence to the investors.
Thank you very much, Alessandro. Last but not least, Dan, please.
Yeah, I mean, it's a large enough market as it is. It's a large market, property valuation. So the fact that there's other players in there is somewhere maybe an opportunity where, without knowing your startup, where you can play and steal some of the existing valuations. Because currently valuations are done pretty poorly. They're just regarding typically, consider factors such as the location, the size, the condition, typical history of properties in the area. If you're doing something really clever to really give you a more accurate valuation, then that in itself might be allowed, enough of a differentiator to steal some of the incumbents. But equally so, if they're worried about the stagnation in the property market, and you've got a tool that is, can work well internationally, then you can, point to the fact that you're planning to launch in, say, somewhere like Florida, where in Tampa there's a very dynamic rate of properties exchange frequently, and therefore, you could talk about the growth markets that you're going to be launching in. It's worth saying property valuations aren't just done, as I think it's Alexandra pointed out, at the point of actually buying a property. They could be done for instance, refinancing, if you're doing a remortgage, or when they're being used for collateral or in commercial properties at the end of the day. So the fact that, it could be used for renting purposes, valuation and what you're going to get rent. So there's a whole, if you're doing some really clever stuff, the actual use and when you use it, and you've got the right cost model, means it could be done for lots of things, because property valuations alone could just be used for collateral, for instance, if you're going to purchase something, or for M&A. So there's a large space and a lot of channels to market and target customers you need to think about.
Wow, this is some amazing stuff. And you know what? I take back what I said at the beginning, because rather than just focus on what you're doing now, you can explore all these other avenues. Although personally, I'm always cautious about then kind of adding all sorts of features in various products. But, if you want to show potential, why not include all of these? Well, thank you very much for that, gentlemen. We've got another question. Oh boy, this is a mouthful. I'll put that in the chat, so I'll read it out loud for those of you that are tuning in via LinkedIn, YouTube, Facebook, or Instagram. And by the way, we're unable to monitor your questions there. So if you want to ask us anything, you need to join us here on Microsoft Teams. You can do that either via the link you have there, or by going to startup-to-scaleup.club and then look for today's session, which is Startup Fundraising Q&A 130. Now, this is a biodegradable packaging materials company for retail foods in Kent. They're at seed stage at the moment. So, a sustainability-focused startup developing biodegradable packaging alternatives for UK food retailers. We're seeking seed funding from impact investors that are wary of giving up control in the early product stages. Now, our goal is to attract investors who align with their environmental mission whilst preserving strategic autonomy in future fundraising. And the question I have for your panel is that our biodegradable packaging startup is looking to raise seed funding from impact investors who align with our sustainability goals, but we're cautious about early stage equity dilution affecting future control. What frameworks or share structures should we consider to ensure that as founders we retain decision-making power? Put in brackets, they're free founders. Sorry, I didn't copy and paste that. How can we negotiate terms that balance environmental impact with investor returns, particularly in a sector where mission alignment can influence product decisions? Additionally, are there common protections in the UK's impact investment landscape to guard founder control whilst bringing in aligned capital? Jesus, this is a mouthful. Okay, we'll go on to the panelists, but one thing I can say is that you may also want to look at things like Innovate UK and a few other similar sort of places where you can raise, or even crowdfunding for that reason. But nevertheless, this time we will start with, let's start with Alexander Fink, then Dan, then Archie, then Alessandro. And let's try and keep it at 1 minute each so that we can answer one question after this, please, gentlemen. So Alexander Fink, I think I said Archie, then Dan, then Alessandro.
Great question. Really like it. Look, firstly, there's some amazing impact investors out in the UK that do early stage, talking Elbow Beach Capital, Clean Growth Fund, just to name a few. And their missions are going to be very aligned to yours in terms of they are there to make the planet a better place when they're investing. So if you're finding the right investors that are investing in you, it's going to be part of their mandate to invest sustainably and to make sure the decisions are going in a sustainable way. When you are fundraising, you are giving up control, and there is a point in every startup where you are going to have to give up control. Delaying it as long as possible is in your interest, but a lot of the times, you know, the more established, bigger VCs will have terms, and they're very hard to negotiate against unless you create a bidding tension on your startup, and then you have a lot more flex to negotiate terms. I would say I wouldn't give everything away in your pre-seed and seed round. You know, the typical amount you raise is 20 to 30% dilution in every round. So normally founders have control up until the Series A round, where the founder equity should be above 50%. At that point, you will lose control to your investors, but the idea is have enough investors on the cap table that are aligned with your way of thinking that most of the time you should be able to enact what you want. In your term sheets, obviously try not to give away too many veto rights. That's a key point early on. You know, I have seen startups with extra voting shares for founders, and et cetera. But again, your VC is probably going to dictate the terms of the round to you, unless you get a really intense bidding war, and then you can say which terms you're taking.
Thank you very much for that, Alexander. I believe the next one was Dan, wasn't it? Or Archie, I'm sorry. Archie, then Dan, then Alessandro. Go on, Archie.
Great question, and sounds like a really interesting business. Would love to learn more. And in terms of how to protect yourselves as a founder, you know, just to reiterate much what Alexander said, but look at different share classes, look at dual class shares perhaps, you know, class A, class B, one being giving you higher voting rights, perhaps even founder vesting, you know, to make sure that your founder's equity vests over a certain amount of time in order to lock you in for the longer term. And I don't know, perhaps even if the discussion of a valuation and how much they get in terms of that isn't really what you need at this moment in time, look at, which I'm sure you have, convertible notes and safes. And perhaps that might be a situation where there is only one investor coming in at this moment, and you would be giving quite a lot of control if you were to just go with straight out equity, ordinary equity investment. So that sort of pushes it further down the line. But yeah, as Alexander said, lots of investors are out there that are very much mission driven in the impact space. That's what drives them every day, as well as obviously the financial returns. So VCs aren't always out there or at all out there to exploit you as a company. It's to work with you as a founder and come to something mutually beneficial. But yeah, thanks.
Thank you very much for that. Yes, Dan.
So first of all, I've got to admire any founder that manages to fit 10 questions in one question, basically. So I think it's an exciting area. It's an area I know a lot about, and I would love and I encourage the founder to reach out to me. And I guess some of the answers would almost depend on certain circumstances of the startup, because first of all, it depends where you're playing in the biodegradable packaging space. There's lots of companies that, for instance, the companies that actually, package something, let's say a sandwich box, aren't necessarily the companies that are actually making the packages. And equally so, your know-how may well be in the chemical that is biodegradable. So you might be better selling this or licensing this on a country-by-country basis to, say, a biodegradable plastic company, or a biodegradable kind of clean film package, or seed transparent. So there's different ways of doing this, and so you've really got to understand your go-to-market on this, and more than anything else, the big challenge when you're dealing with biodegradable plastic and you're a seed stage company is even if you find very interesting traction, which you can point to investors, they often want to buy your packaging at mass volume. If you're a big supermarket, a Sainsbury's, Tesco's, or Waitrose, or whatever it may be, and you want packaging replaced, they want to do it overnight. And the fact that that might require a big capex investment on you to create the packaging, the factory to be able to build that. And that is one of the big challenges. So typically we see in kind of this kind of area, there's usually a split kind of business model where they kind of have doing specialist biodegradable packaging, for which is a high value, versus, for instance, those more commodity for everyday sandwich, for instance. So there's a lot of this comes down to the details and the analysis. I think the way you actually protect yourself is important, but you can often do this on a kind of regional basis, and come down to the terms and conditions. And I'd love to follow up on that.
Thank you very much, Dan. And last but not least, Alessandro, please.
Yeah, thanks, Anton. Yeah, I also have quite a few ideas to share. I don't know if I can do more than a minute, Anton.
If we can, I'd love to go. We've got at least one more question and only 9 minutes to go. So if you can, I'd really appreciate it if we had time for that as well, please.
Okay. I'll keep it short. Then, as Dan said, maybe the founder can reach out as well, because I do have.
Yeah, actually, that would be nice. All our panelists have got their LinkedIn profiles linked to this call on any link that you've seen an announcement. So please reach out to them. And actually, let's be honest, you've punched in 65,000 questions and you can't even be bothered to join us live. So I know we can all have our reasons, but if you really want your help to count and matter, at least be here so they can ask follow-ups and so on. But anyway, sorry, Alessandro, we're unfinished. Go on.
No worries. So in 1 minute, my summary points are, of course, valuation will drive the dilution. And so I would suggest working with your financial advisors or CFO or whoever is doing the numbers to make sure that your investment round is commensurate to adequate dilution, as was said before, 20 or 30%. That should allow the founders keep control. Secondly, there are legal structures that can be put in place in the articles of association of the company to protect the purpose of the organization. You can do that either through the B Corp suggested changes to the article of association, which embed the purpose of the company into the articles, or looking at organizations such as Purpose in Germany that promotes the legal frameworks and the governance structures for organizations that want to protect their purpose and mission, like in this case. And this can be done also with specific structures such as it's called stakeholder ownership, I think. So you can actually embed and protect the purpose of the organization legally as well. It's quite interesting that the founders are quite concerned about control, because if they're so focused on the impact, I think control should not be a priority, but achieving their purpose and mission should be more important than control. But I understand that it's coming from a point of view of being aligned with investors and protecting their environmental impact. And so what I would highly recommend is really going beyond the formal process and term sheet negotiation with investors, who of course are investing for impact, but also trying to understand, the person they're meeting and finding resonance. And so the trick there is really to also develop a personal relationship outside of the meeting rooms. So I call it the beer test. So go out for a beer and relax and talk about anything that comes to mind, not business, and see if resonance is there, so that you can make sure that there is no greenwashing in the impact investors you're talking to.
Thank you very much to all four of you. My quick inputs and 2 pence on this is look at things like Innovate UK and various other granting, let's call them organizations. And also perhaps look at accelerators. A good accelerator worth their salt may not give you as much money as investors would, but a decent one won't take as much percentage, and they don't normally put their foot down on having as much board power as, let's say, institutionals like VCs and others would. So try to bear that in mind, at least to start with, because that, as all the chaps here have said, the stronger you are, the more ammunition you have, the easier it will be for you to negotiate the right terms. So to get to that point of strength, maybe look at grants. Now, I know it's easier said than done, but to be honest with you, it's probably just as much input as finding the right investor. Right, we only have 5 minutes to go. So this time we really have to keep it to 1 minute if we don't mind doing that. Please, gentlemen, our last question is a sports tech founder in Leeds, pre-seed. She's a former athlete herself, and working on an app that helps amateur athletes train using AI. The challenge is convincing investors of the scalability of a product in what they see as a very niche market. How do I frame the broader potential to attract investors who may not understand the market size? And this is why we should have you here, so we can ask you a few more questions. But some quick pointers, perhaps. We will start with Alessandro, Dan, Archie, and Alexander, please. Take it away, thanks.
All right. So I guess I would suggest, to do your homework and research around the total addressable market and how you try to achieve it. Also figuring out whether your tool can really convince, people who are not currently athletes or sportsmen to become such, because you're actually empowering them in doing that. And as I was saying before, either using your existing network or smart digital media campaigns, demonstrating the traction that you can achieve, doing some trials, with small investments, and capturing KPIs that can prove the market traction as well.
Thank you very much, Alexander. I think the next one was Dan, wasn't it? Dan?
Yeah, I mean, niche markets aren't necessarily a bad thing, by the way. I mean, without knowing more about what you do, for instance, you might be dealing, for instance, with where your target customer is the professional athlete, and the professional athletics world does have money to spend. It's really important. It's their career at the end of the day, and there's a whole sort of associations that will fund, for instance, Olympic athletes or whatever it may be, top talent in sport. I've been involved with a few startups, but likewise, the kind of casual athletes or runner or maybe that's a large market that maybe have less pounds or dollars to spend individually, but there's a lot of them, and we see them every day running around the streets. So you've got to really understand who your customer is, because an athlete is not really a customer. It's the whole could be anything from a Formula One sports driver who's to a casual golf player at the end of the day. Scalability, I mean, usually not a problem unless you're dealing with some very niche sports. But even then, something like, I'm involved with a cricket startup at the moment. You penetrate India and you've got the right market on that one. It's a massive opportunity, even though a lot of countries, don't even play cricket. So it's about framing it and understanding your market and positioning it right at the end of the day. Don't worry about being focused. You only, if you get a big enough slice of the pie, it doesn't matter if the actual size of the market is quite small.
Thank you very much, Dan. I believe it's Archie and then Alexander, please.
Yes, just a quick one from me. Exactly as Dan was saying, it's how you frame it, it's how you convey it to the investor. If you're looking at, well, give them an idea of sort of the size of the market, the size of the revenue you could potentially get per person, per individual, per sportsman, and then how that would look in terms of building up, in terms of a group, let's say, a national organization, a sports outfit. It's framing how that you portray that narrative.
Thank you. I would add that obviously sports and personal health has never kind of been bigger than it is at the moment. One way I'd look at it is maybe doing a freemium model for casual athletes with a bolt-on subscription for anyone that wants to pay for the more advanced amount. Freemium models can work really well, especially in sports startups. I'd bench market against something like Park Run potentially, which is both for casual and for professional runners, and make it accessible rather than necessarily going after niche markets, because a lot of people are into sports and fitness, and being able to train more effectively and be competitive against your friends and other people is something everyone likes doing. So that would be my advice on that one.
Thank you very much, Alexander. The only thing I'd like to add here is, and I'm basing this both in my experience with the investors that I've seen and worked with, but also those that I'm now helping with due diligence and assessments, is that the real reason why investors are sort of asking questions here is because B2C can be quite tricky in terms of cost per acquisition and how you retain and stuff. So maybe I think somebody here touched on it, but if you can find a way that you are going to do this as B2B as well, or maybe B2B2C or something along those lines, that normally seems to kind of bump up your chances in terms of getting a higher interest from investors. Nevertheless, we are now 1 minute past the line. If the panelists here would like to leave their LinkedIn URL in the chat for people watching the replay of this, please feel free to do so. I know we're 1 minute over the line, but before you leave, if you'd like to give us any parting words, you're more than welcome to do so. If not, just thank you and have a good one. But Dan, Archie, Alexander, any parting words?
In the spirit of athletics, it's a marathon, not a sprint. That's my experience with startups and investment.
Thank you very much for that, Alexander.
I would just say, as I said, fundraising takes a lot of time, and it's a numbers game. Try and speak to as many people and try and make connections and make sure you regularly update investors and build a relationship over time.
Good on. Archie?
Absolutely. Just to reiterate, marathon, not a sprint. Exactly. Things take a hell of a long time, and often come back to the first conversations you've had, which can be frustrating, but that's how relationships work. And yeah, listen to and take on board as much advice as possible, and don't get, you know, downhearted and by a lot of rejections. But yeah, best of luck to everyone who's tuned in.
Brilliant advice from all three of you. Huge thanks to everyone that tuned in today. Those of you that tuned in via the live streams on LinkedIn, YouTube, Facebook, or Instagram. Those of you that join us here interactively on Microsoft Teams, although you didn't put any of the questions in the chat there. Next time, please try to join us live here on Microsoft. It makes for a much more entertaining conversation, but also, let's be honest, it's also much better for our panelists to give you sort of more comprehensive answers and be even more helpful if they can ask follow-ups. Nevertheless, we just a quick reminder, we run 6 regular sessions: Mondays talent, Tuesdays product and tech, Wednesdays growth, Thursdays fundraising, second Friday of the month it's legal, and third Friday of the month it's finances. They're all from 12 to 1 p.m. UK time, and you can RSVP to any of them via our site startup-to-scaleup.club. Whilst you're there, you may also want to join our WhatsApp group, and you've got an icon of that top right hand corner of our site, and bottom at the bottom of our site there's a an icon, a link to join us on WhatsApp. As far as my parting words are concerned, just remember, the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime, and be kind to yourself and everyone else for that matter. Our panelists have put their links on the chat here, but you can also see them on our shares. So please follow them on LinkedIn and reach out to them if you've got anything that needs working on. Obviously, they do this for free so that they don't need to keep doing free stuff. On the other hand, bear that in mind and be respectful of their time. But for now, thank you again, and God bless you all. Bye-bye for now.
Thank you.
Bye-bye.